Hi, welcome to the March Q&A. The first question: what is the strategy behind the selling to generate cash? Are we not trying to time the market, especially for the long-term portfolio? Are we not better off just buying in SIP all through this time? So interesting question. Timing the market is extremely tough, right? To do it correctly, consistently over long periods of time is very, very difficult. Now, that doesn't mean that we should not try to do it, right? There are people who are able to roughly time it. I mean, when I say, they are able to time it, it doesn't mean that you will get the, tops or the bottoms. What it means is, you may be able to get in at 10-15% from the top, and again, get out 10-15% from the top and get in again 10-15% from the bottom. So that is what I mean roughly by timing. And it's an endeavor that I think which should be tried. It's not something that we should say just by reading some foreign books or reading some gyan saying that it is not possible, that we should let it go. It is not impossible. That's the way I think. You have to make an honest effort of it. And even if you are not, see, the difference is, if you say that it is not possible, then it is not possible, right? You will not even try it. But if you think that, okay, can I do something about it, then at least you will think in terms of how to identify tops, how to identify bottoms. Can I do something? And you may not get it at the exact top or bottom, but you will get close enough. So that's one. Second is, when I think of a simile, it's like you look outside when you're going out of your home and you see dark clouds in the sky, and you are carrying an umbrella with you, right? So you decide to carry an umbrella. The thing is that it is possible that the sky remains cloudy for the entire day and it does not rain, in which case you will have the burden of carrying that umbrella, remembering where you've kept it. A lot of us have the tendency of putting in the umbrella someplace and then forgetting about it. So those kinds of things will happen. On the counter side, if it rains, that umbrella is going to protect you from the rain and possibly from getting sick and all that. So same thing here. So when you have a portfolio and you're doing partial selling, you're not taking a all out cash call, you're not getting 100% into cash, you're selling 10%, 20%, 30%, then what you're doing is exactly this. You are trying to say that, okay, there are dark clouds in the sky, let me carry an umbrella with me. And in a portfolio, the umbrella is your cash. So what you are doing is, you are taking some part of your portfolio, liquidating it and keeping it as cash, so that tomorrow if it rains, right, which means that if the market goes down, you are in a position to use your umbrella, use your cash to deploy at lower levels. So that is the whole idea of, or at least when the cloud cover goes away, when you see that skies have become less cloudy and it's clear, then you can deploy that cash once again. So that is the broad theme of why you have to get in or get out of cash. Coming to the second part, which is SIP. Now SIP is a great mechanism for saving and putting that money in a systematic way into a portfolio. It is immensely helpful in being disciplined, and because most people have a monthly cash flow, right? Even if you're a salaried employee or if you're doing a business, you still have some cash flows coming in on a monthly basis or a quarterly basis. The whole idea is that you are able to then take that money and part of it you save and put it in a portfolio. So that's the whole concept of SIP. And this whole idea of rupee cost averaging. In fact, to me, more important than that is this idea of consistently and in a disciplined manner adding to your portfolio. Now it is possible that definitely, I mean, if you have, say, a large pool of money at one point in time, you are actually better off putting it mostly in one shot, or in very small staggered units, like what I ask people to do in the long term portfolio. You take 1 month or 2 months, and then you start buying within that period, break it up into 4-5 tranches, and you buy, right? I don't ask people to do a monthly SIP when you are starting off. The monthly SIP you can do it once you build up the portfolio, right? So the SIP and market timing or selling cash, generating cash, etc., are not very, they are not tied together. By that, what I mean is, typically you will find that the SIP amount that you are doing is comparatively very less compared to your portfolio value. So if you have a portfolio, say, of 10 lakhs, you might be doing an SIP of 5,000 or 10,000 or 20,000, right? So the 30% or 20% of portfolio selling that you do is more to protect your portfolio during cloudy times. And let's say if you if you're selling 20%, so you're protecting 2 lakh rupees in your overall 10 lakh portfolio, whereas when you are putting in an SIP, you are just adding, say, 10,000, 15,000, 20,000 rupees, right? So that there is no comparison between an SIP and cash, selling to generate cash. So don't confuse these two. They serve completely different purposes, right? So you could actually have a scenario where you are selling to generate cash, but you are still continuing to do your monthly SIPs, right? Moving on to the next question. How do you decide something cyclical has become a structural story? Now that's a very interesting question. So typically, if you look through history, you will find that this practically never happens. I would not say the word never, and the reason I will not say the word never is the sugar sector in India right now is showing signs of turning from a cyclical one to a structural one. And obvious reason is that if India starts or progresses more down the path of ethanol, then it will be a structural story, at least for the next 7, 8, 10 years before we move or transition into electric vehicles. Now once we move into electric vehicles, you will see a very, very sharp drop in ethanol consumption, because you are replacing your older or incremental growth in ethanol is going to come down drastically, because new vehicles that are going to come on the road are all going to be EVs. While on this topic, I think these are challenging times whenever a transition takes place from ICE engines to EVs. What happens is, right now I think we are very close to coming into that place where we have been hearing about EVs for maybe last 7-8 years, right? But you will see that in a span of the last 1.5 years, especially with Tatas, with Nexon, I think Tigor, and now increasingly they are going to come up with newer versions of electric vehicles. Maruti has now said that they will come up with one. Hyundai is planning to come up with EVs. That is on the 4-wheelers. 2-wheelers, I think everybody has started, they are in the game, whether it is Ather, whether it is Bajaj, TVS, Kinetic. I think most of these people are now in the fray. And Hero, I forgot Hero. Hero is probably the biggest player in that market. So what is going to happen is that we will see a very quick transition, right? In a span of 2-3 years, we will see that the adoption of electric vehicles, electric scooters, etc. will suddenly, it will be like a on-off switch. Suddenly you will find that people transitioning over, and then you have a problem with all this ethanol that is there. But till that time, ethanol could have a pretty long cycle. Now, whenever we are looking at cyclical or structural, whenever we use these terms, I think we have to understand that there is nothing which is structural in nature, right? There is no structural business in the world. Every business has demand and supply waves or cycles. It is just a question of the duration of the cycle, whether it's a short cycle, whether it's a long cycle. Long cycles will last for many years, sometimes many decades. Now, typically, if you see, bond rates or interest rates have long cycles. So, interest rates, when they go up for sometimes a decade or 2 decades. When it goes down, it keeps going down again for a decade or 2 decades. If you look at US markets, and the reason I talk about the US market is because they have a longer recorded history. You will see bond cycles lasting typically 40 years, right? So 40 years rates go up, then the next 35-40 years they go down, and so on and so forth. So those are called long cycles. You also have short cycles where the cycles, the turnover is very, very quick, which could be like sugar, cement, autos, etc., where within a span of 2-3 years, 5 years, you have a boom and bust cycle. That is what we need to understand. Even things like FMCG, right? At the macro level, you might feel that okay, food is something which has extremely long cycle. Everybody will need food. The thing is that tastes will differ, right? So there was a time when, say, junk food like burgers, etc., were growing phenomenally. Now you will find that there is this trend of healthy food and things like that. So these kinds of things go in and out of fashion. Basically they go in and out of trends. So the point I'm trying to make is that it has cycles, so long cycles or short cycles. Okay, let's move to the next slide. So how has been your experience in riding momentum? So momentum is one of the factors. So when we talk about factor investing, momentum is one factor, right? So there are different factors. So when we are investing, let's say the average return is the market return. Anything which generates above average return is called alpha, generating alpha. Now alpha can come from many things. These things are in technical parlance called factors, and from there this term of factor investing has come in. So what are the examples of factors? So value is a factor, growth is a factor, growth at a reasonable price is a factor, momentum is a factor, so quality is a factor. So all of these things that we generally talk about are factors. Now what I try to, if you look at this chart here on the screen, you will see that what I've tried to do is I've tried to come up with a very easy depiction which says that you have a company can have poor or strong fundamentals, right? And the stock price can have poor or strong momentum. So our job is to look for stocks where fundamentals are strong and the stock price momentum is strong, right? That is your star category. This quadrant will deliver you stocks like an HDFC Bank over 20-25 years. It will deliver you stocks like Asian Paints. It will deliver you stocks like Pidilite. It will deliver you stocks like a Divi's Lab, PI Industries over a period of time. So these are stocks where it will come up here, Bajaj Finance, over the last decade. So consistent, strong fundamentals and good stock price momentum. Right? So they will form this bucket. Then you have this quadrant where you have strong momentum, price is going up, but fundamentals you're not very sure of. Those are good trading candidates, right? If you have a proper risk management process, good position sizing, you can trade in and out of these kinds of stocks and make very, very good returns. But you would not want to sort of buy and hold onto those stocks because the fundamentals of the business is not very strong. Again, many examples, things like a lot of cyclicals will fall in this trade kind of category, and a lot of cyclicals will also fall in the value type of category. Depends on when you are buying it, right? So value again is very simple, where fundamentals are strong but there is no price momentum. The objective is to see that ultimately you move from either trade to the star quadrant or from value to the star quadrant, because end of the day it is price momentum which is going to give you money. After everything else, when all gyan stops, the final reality is that the stock price has to go up for you to make money. The reason for the stock price going up can be different, right? It could be many things. It could be that fundamentals, the stock company is doing a great business. It could be because of an acquisition. It could be because of a turnaround. It could be new capacity coming on stream. Many things, right? It could be low float in the stock. Many things can determine the price rise, but end of the day, how you will make money is if you invest 100 and end of the day you are making 120, right? And you are able to sell it at a higher price. So the first quadrant is something that makes no sense, and obvious thing is to avoid, which is poor fundamentals and poor momentum. But I see that a lot of people even get drawn to that. Yes Bank, a lot of people ask me, Yes Bank kharidna hai kya, Vodafone lena hai kya. Now you are in this territory, right? You have 5,000 stocks. Broadly in your mind, put them in these 4 categories and see where they are. Why you want to waste your time on a stock where fundamentals are questionable, there is no momentum? Let the fundamentals improve, let it get to value, then you'll start thinking about it. Or let the momentum start happening, then you can take it as a trade, right? So that is the whole framework that I personally use. All our most of our quant and quant strategy is here. It basically is in these 2 categories where the momentum is strong, right? Fundamentals could be moderate or it could be good, but where we are looking at momentum. Hit peaks we are trying to get somewhere in between here, right? Where fundamentals are average to strong, and you are looking from either it moves from value, it's sort of this area. I don't know whether you're able to see the cursor on the screen, but it's roughly this zone where there is it could start from value, then price starts moving up with strong fundamentals or moderate fundamentals, and you have decent price momentum. So that's where we try to position hit picks. Our long-term portfolio is typically in this zone where it's either value or it's in the star kind of zone. So that's the way I try to think and position my portfolios. The next one, which will be the top 3 industry sectors for the next 10 to 15 years, and your approach to investing when overall market looks expensive. So I think it's very difficult to talk about which sectors will do well. I think in a growing economy like India, all sectors will do well. Consumer sector definitely will do well. Pharma especially, more biologicals, more gene editing and advanced technology based pharma. I think that is where we will see a huge amount of focus in the next 10-15 years. And by far I think technology is going to be the biggest determinant of change in the next decade. Now when I talk about technology, I don't mean IT. I mean technology, whether it is IT, whether it is intervening in other industries, things like what we are seeing is climate change technology, agri-based technologies, education, electric vehicles, newer fuels, newer mobile technologies, migration to 5G, 6G, digital technology. So all of this, metaverse, NFTs, these are going to drive what and how we look at us, look at society, how we interact with people, how we do business with one another. That is that is what my take is going to be. We are going to be a much more tech driven society and set of people. In terms of markets, I think first of all, I think with the last 6 months of markets consolidating, I think the valuations have come off a bit. It's not as highly valued as we were, say, 6 months to a year back. Having said that, what I also think is that globally inflation is going up. In India, anybody who goes out to shop or goes to the vegetable market, that there is significant amount of food inflation which is happening. People who drive cars or motorbikes, petrol prices have gone through the roof. So inflation is impacting all of our lives. That's going to happen. That is for sure. The challenge is that how do you position your savings or your portfolios with inflation at 7-8%? Maybe the published. My personal take is our inflation basket. If you use your consumption basket, you will find that inflation is higher than what the CPI is. And if you are looking at an 8% inflation, you are not getting even close to that in a fixed deposit, right? So debt is out of the question. In an interest rate rising scenario, if you are investing in debt mutual funds, you will start seeing capital erosion unless you have a very shorter tenure paper, right? So the challenge is that debt is not going to make you a lot of money. Equity valuations, in my opinion, are likely to compress, right? So basically we will see a lot more skepticism coming into the market, a lot less liquidity. That has been the crux of the rally globally in all asset classes. So that I think is what is going to happen in the next 2 to 3 years. So my personal take is we will see a range bound market for a pretty long period of time, till the time the valuations get a little bit more reasonable and compressed. Even within that space, you will find businesses which will do better than others. Our job is to look for those businesses. A well-run, good managed business in an area which has reasonable pricing power, which has good unit economics, will still make you better returns than what you can get elsewhere. That is what that's what I think. So I think next 2-3 years we should have moderate expectations from equities. I think last 2 years have been extremely good. So it's very unlikely that we will keep repeating those kinds of performances in our equity portfolios. So if you have a more reasonable expectation, I think it will do we will do much better over the next few years. I think this is the last question for this month. Many of us don't really have such a circle of competence developed. Would this mean we can't venture into complicated sectors wherein our in-depth knowledge is required? So first of all, circle of competence is not something you are born with, right? It's not that Warren Buffett was born with the knowledge of insurance sector and financial sector. He made an effort. He learnt about the industry. he looked through, and this takes time, effort, going through different immersing yourself in that particular industry, reading up all you can about it. So one way, so let's give let's talk through an example. So let's say you are hearing that real estate sector is going to do so well in the next few years. It's on a possibility of a turnaround in the sector. So how do you go about increasing your circle of competence in the real estate sector? You don't know too much other than that people whatever is common sense or common knowledge, right? People may pay money to a promoter or a builder, and you can buy a apartment. So one way of doing it is you look at let's say what are the top few companies that are listed in the market. So you make a list of say 5 companies. You look at say a Godrej Properties, an Oberoi Realty, a Shobha, maybe a Prestige, Brigade, Purvankara, so on and so forth, Kolte Patil. So you make a list of these companies and go through their annual reports. You don't have to read everything. I mean, if just read the management discussion and analysis, you will get a sense of what is happening in the sector and what is happening in the particular company. Now read say the annual reports for the last, say, start off with the last 3 years, then skip a few years and go back another 4-5 years, so that you can see the shift in cycle, right? So skip every say go back to 2010, so read 2010, 12, 14, 16, 18, right? And slowly what will happen is you will start getting a reasonable sense of what is happening in the industry. Keep Google alerts on the companies, on key players in that space. Whenever there is an article in a reputed newspaper or a magazine, go and read it. There are great videos on YouTube these days. Choose videos from reliable sources. Preferably I still prefer big media houses. I think at least they have some quality control in terms of putting out content, rather than a lot of random videos that you will find on YouTube. Or else, if there are videos from people or from the companies themselves, or from people who personally, or you trust that okay, this guy talks sense or he has some background, then watch those. Same thing for blogs and things like that. So because entry barrier in YouTube and writing blogs is so low today, anybody and everybody can start writing. So think of it like a town square. If you are walking into the center of your city, you will not listen to any random guy who's shouting at the top of his lungs, right? Because maybe that guy is crazy, that's why he is shouting. Today social media is something similar. You will find thousands of random people talking about random stuff. You need to know who to listen to, right? So the easiest filter when we are beginners is to go to reputed media channels. Look at say a Financial Times. They are coming up with videos. Maybe CNBC, ET Now. They have lot of interviews with promoters, etc. So those are things which, if you consistently keep doing for 3 months, 6 months, you will start having a very good understanding and knowledge of a particular industry, right? So then keep doing that over and over for different industries. That will help you increase your circle of competence, right? There is no magic bullet to it. It just requires effort, time, passion to learn and be curious. That's it. Nobody starts everybody starts with a blank slate. Nobody starts with deep knowledge about a sector. It's a learned skill. With that, thank you for thank you for listening, watching, and keep your questions coming. We'll come back again next month. Thank you.